Hello and welcome to the Switzer Super Report webinar. I'm Peter Switzer. I'm hosting today. Paul Rickard's swanning around the USA, so it gives me a chance to actually, rescue my own business from that domineering Paul Rickard. Thanks very much for joining us. Joining me is the great James Dunn of Dunn Media and the Switzer Super Report. James, thanks for joining us.
Pleasure, Peter.
Now, we're going to try and answer as many questions as possible over the course of this webinar. We'd love you to get involved, and you can either get involved by vocally voicing your questions, or you can send them in an email, and the wonderful Bernadette will make sure we get those questions and we answer them. Before we start, there's an important disclaimer, which I hope you know. This content has been prepared without taking account of the objectives, financial situation, or needs of any particular individual. It does not constitute formal advice. I call it brilliant personal investment education. Any individual should, before acting, consider the appropriateness of the information in regards to their objectives, financial situation, needs, and if necessary, seek appropriate professional advice. A couple of housekeeping issues. Please close all applications and programs that are not in use. Then please ensure the volume on your computer speakers is turned up to a comfortable level. And you can send in questions during the webinar via the question box. Please let us know if you have a mic available to ask your questions live. I always love it when we try to work out whether our questioner wants to go public or whether they want to hide and just take the typed in question. It's always a nice piece of drama while we're waiting for someone to say something, but we do love hearing your voice, so if you want to get involved, get involved. Okay, just to kick off, I'd like to make some opening observations before I get James to throw his piece in as well. First of all, I thought we should talk about the market volatility and what's going on. What I might do is have a quick crack at this and then ask James for his views as well. But clearly this market volatility we're seeing right now, it's a function of a number of things. I think a lot of it is of an economic origin. Question marks over the Chinese economy, the Japanese economy, and even the USA. Even though I'm firm with the belief that the USA is heading in the right direction, there are a number of commentators out there who feel as though the most recent run of data looks a little bit weakish enough, not weak, but weakish enough for the Fed to delay raising interest rates this year, despite the fact that Janet Yellen, the Fed boss, has said she thought it would probably be appropriate to raise interest rates this year. There are US commentators saying that, well, maybe the data's not that good. Christine Lagarde from the IMF is kind of saying, don't do it unless you're really sure the US is going to be strong. So that's out there. We know commodity prices, these are the real pain in the neck for particularly the Australian market, but it has been affecting other markets as well. When materials are down, it hurts the US stock market as well. So that's in the mix and why we've got volatility. We've got this Fed interest rate rise anxiety. I think a lot of us would love them to get it out of the way, see the market sell off for a short time. Then people say, well, look, there's even more value there. They're doing it. They're cutting interest rate, raising interest rates because they know that the US economy is looking stronger and stronger. But until they do it, there's anxiety there, and there's anxiety around hedge fund players and short sellers. They can get in to increase volatility. And if you've got economic problems and question marks, you invariably have earnings problems because, great economic growth gives great revenue, which then gives justifiably high share prices and vice versa. So at the moment, there are question marks over earnings. I should say, I interviewed Michael Knox on Monday from Morgan's. He's expecting the US earnings seasons, which starts October 8 with Alcoa. He's thinking it could be better than expected. And he also does believe that the December quarter numbers will even be better than October. So I'm keeping my fingers crossed on that one. I'm hoping that Michael Knox is absolutely on the money on that one. And also, remember this, a correction, statistically speaking, is 10%, a fall 10% or up to 19.9%. And once you get 20%, they call it a bear market. But the word itself, correction, tells us everything about what's going on. We were more optimistic about the global, the US and the Chinese economic outlook. when we learnt that, or that it's not as good as we expected, those share prices that had been bid up in anticipation of a stronger global economy, China's economy, etc., and also in the Australian economy as well, because remember we got to 5,996.4 sometime this year. But when we started downgrading the economy and downgrading the earnings went with it, therefore share prices need to be corrected. And that's what we're seeing, a correcting of what they thought the share price should be. And that's what's going on now. James, is there anything you'd like to throw into this little story of mine about market volatility?
Well, I think we've also got to look at what came out of China, Peter, which was the sell-off in their markets, which, I mean, we've got to separate, when you look at China, the markets from the economy, because the Shanghai market and the Shenzhen market, they're large, but they're not really influential in terms of what China actually does. So most of the Chinese heavyweight stocks are listed in Hong Kong, and really their actual stock markets are quite divorced in a headline sense from how the economy is going. But you had that sell-off which started in China and began to develop ahead of steam. And I agree with Jonathan Payne, who was quite bullish on China. Jonathan's an independent economist, and he was worried by what came out of that, Peter, only in the sense that the measures that the Chinese authorities took to stop or try to stop the sell-off in stocks, which a lot of developed world countries have gone through that kind of thing and tried to bring in measures to stop a sell-off in stocks, and it doesn't really work. I mean, we saw Japan in 1987. All of the crashes in the developed world have had governments trying to step in and stop it. It doesn't really work. And Jonathan made the point that the big casualty out of all of that happened on the Chinese stock market was the credibility of the Chinese authorities. And on economic data and the performance of the economy, Peter, we've given them a great deal of credibility, running the show, transitioning China in a managed way down from very high commodity intensive rates of economic growth to something more resembling a Western economy, lower economic growth, but growth driven by your own consumption, which is where China wants to be, which is where Australia is, where the US is, etc. Long transition, but they were doing that well. And Jonathan made the point that they panicked a bit in the face of the Chinese share market sell-off, and put journalists on trial for spreading rumours, and brought in some heavy-handed measures. And that credibility loss, Jonathan contends, was the major casualty to come out of that Chinese stock market worry. So now we've got that financial storm. Not only the financial storm began to affect markets in the West, Peter, but also a bit of a worry as to how the Chinese authorities mishandled it. So that sparked our Western world surprise correction, August, September. But coming back to China, economically, the growth rate is coming down. We all know that. It's just a matter of where it finally arrives. So that shouldn't have shocked anybody, but what did was the way the Chinese authorities effectively let the share market correction there get out of hand.
Yeah. Okay, let's go to is this a buying opportunity now? I think the bottom line is a lot of good companies have been really belted up. And if I go back to where I started from, and I completely agree with James, that to me, the Chinese mishandling of the stock market, then followed up by a run of poorer than expected economic data, has like poured fuel on a fire that was really started because the global economy is just not as good as we were hoping on. And it hasn't been helped by the ridiculous issues in Greece and the distractions that created. And I often talk about a snowball of confidence, and that snowball was really slowed down by a lot of those things that we've talked about so far. In terms of buying opportunities, if you believe that, and this is what Tanya Brandwhite from Macquarie said probably 3 or 4 years ago, and I totally agree with her, that we're in a long, grinding higher economic cycle, and in that grinding high we'll go sideways and we'll go up and we'll go down, but I think the overall trend is still going to be up. therefore there are buying opportunities, but the actual returns that you get might not be as quick as you like. But I still think everything I'm seeing now makes me believe that despite all of the question marks out there, we're more likely to go up than go down. And I think the consensus of most people in the market probably supports me at this point in time. The Fed,
Well,
you're going, James?
Oh, sorry, I didn't mean to
No, it's
jump
fine.
in.
I love the interchange. Go for it.
But this is what always happens with a series of numbers like the index or stock prices. They correct from time to time, and the good ones eventually recover on the basis of the fundamentals. Now, one of the main things, obviously, in Australia is that when share prices fall, the dividend yield rises in the other direction, or goes inverse to the share price, and so you had a good percentage point added to the forecast dividend yields of some of our top companies, and that in itself starts to, and we've seen that, starts to put a floor under the share price. The attractive nature of the yield brings buying support back into a lot of these stocks.
Yeah, without a doubt. And I did make a reference to the Fed. We are in a waiting game situation with them, and I think Janet Yellen's a very cautious central banker. Bernanke clearly used quantitative easing to try and bring America out of its very difficult situation, and I think they are coming out. But she is aware and she's afraid that one false move and a lot of the good work could be brought undone. So, but as I say, I'm interested in your view just quickly on this one, James. I would really like to see a great jobs number overnight, a great jobs number, so that we then can be convinced that we will see a rate rise. And that kind of certainty may well improve or reduce the amplitude of this volatility. What do you say?
Well, we definitely would like to see a good jobs number. And look, I'm probably in the camp, Peter, that thought the Fed missed a chance last month, or this month. Last month. We're in October, and it could have been a rise, and we all are waiting for it. And it's so annoying, Peter, that the markets, or the US markets, are almost treated as a child, that they couldn't handle a rate rise. It takes us back 2 years to the taper tantrum. And the bottom line there is that if they do raise interest rates, it will be because they believe the United States economy is finally going well enough to handle it. Now, that should be good news for the stock market.
Yeah.
But they've become so used to the stimulus of low interest rates and everything that's QE and everything that's been done for them to pump in liquidity. They've become so used to that. It's almost like they can't imagine a life without it. And if there are animal spirits in the US economy sufficient that the rates can be lifted for the first time in, 7 years, that would be good news. And it's annoying, to say the least, that the stock market persists in treating it like it would be the worst news it could hear, when it wouldn't be.
I'm totally up with you on that one. Now, finally, how will 2000 end for stocks? You know, in my most perfect scenario, we get an interest rate rise in the USA earlier than expected, but you know, most of the experts are saying it's going to be December. I must admit, I don't know what. There's no statement, I think, in October. What about November? I'm not sure about. James might know that. I'll come back to you in a second on that one, mate. But they're talking December. I'm just hoping that a December rate rise doesn't get in the way of a possible Santa Claus rally. But whatever happens, if we don't get that rally towards the end of the year, I'm sure we'll get it in the early part of next year. Because, as I say, I'm pretty bullish on where the US economy is going. I'm kind of hoping that China might just surprise us. We got a little bit of a surprising number yesterday on manufacturing. It wasn't all that big, but it was more positive than expected. But I do think we'll see a bit of a bounce for stocks towards the end of the year. And I'm just hoping that the Fed decision doesn't get in the way. James, finally on that one?
Well, one thing that I'd like to mention here, Peter, which is a bit of a worry we've seen in the last couple of years, is this concept of frozenomics. And that is that the first quarter of a calendar year in the last 2 years has been ruined in the United States by severely cold weather.
Yeah, that's true.
And that's is that going to become more or less a permanent factor of the United States economy? Now, that's a worry, because that would mean if they don't get a rate rise underway before the worst of the weather comes, they would then be dealing with data that could be artificially weak because of frozenomics. And another thing which is tied up with frozenomics is the fact that, maybe not caused by frozenomics, but certainly happening at the same time, that the Fed and the United States have become serial revisers of their data. And so you get a print that'll come out on their GDP or other data, but jobs in particular, and then the next quarter they'll revise it. And obviously massive amounts of money move around on these data numbers, these quarterly economic numbers, but they're quite often revised and in very big variances. And I sometimes look at that and think, or wonder whether the various bodies that measure some of these figures in the United States really get it right. Yeah. I mean, we know that China, the GDP figure is rubbery, and there's probably other measures you could look at in China other than GDP growth officially. But am I alone, Peter, in thinking that the way the Fed has presented data in recent years has left a fair bit to be desired?
Yeah, I guess so, James. I've also been aware of this frozenomics thing, and invariably I've been arguing that don't trust these weak numbers in the early part of the year. They do turn around. So it's a very good point. Let's pray that America doesn't get a very cold snap again in the first quarter. Let's go to the market and sector performance. And what's interesting is that if you just look at the price performance, you know, the September quarter, it was a bad one, down 3.56%. But if you look at the year to date, we're down 7.2%. But if you offset it with, you know, your dividends, we're around down 3.68%. So we don't need much of a bounce back or a Santa Claus rally to get in positive territory to beat term deposits. Because at the end of the day, if we can beat term deposits, it's okay. And I'm hoping that we can at least, you know, walk away with a 4 or even a 6% gain on the year. But what I find interesting about this table, and Bernadette, does everyone get to see this table? They do. Well, I think it shows you that the sectors that have done very well. Let's just go quickly through it. Consumer discretionary year to date up 4%, which I think is a good sign, the fact that those companies have done pretty well. Healthcare, you expect them to do reasonably well because they're a defensive kind of sector. But I love the fact that industrial's up 10.21. To me, that's an omen that we are poised and we want to do better. Sure, there's a lot of currency benefits in there for industrials, but the fact that, you know, both consumer discretionaries and industrials are still in positive territory, which fortunately we did tip in the Switzer Super Report. I think James's writings also tipped many of these sorts of areas. That's a very good sign, and A-REIT's predictable, you know, given the returns they make compared to term deposits. That's pretty predictable. And utilities being defensive, 13.48%. So from my point of view, if someone was a bit cautious and played a defensive stock in the call and had a crack at some of the things we recommended, like industrials and consumer discretionary, then you'd be pretty happy. The one thing that probably would surprise a lot of people is consumer staples, down 5.22%, but a lot of that would have been the failure of Woolworths. James, what do you see there?
Well, I think it's no surprise that most of the sectors are down when the market falls like that, but some of those industrials, some of those IT stocks, and really where you've got the good performers, which they are the only two, but you've got in that sea of red the scenario that I was referring to before, Peter, where eventually the stock price is knocked down enough to the point where there's some attraction that starts to come in.
Yeah.
And that's what investors are having to look at now with the Australian market as to which of those sectors, which of those companies now look attractive. And look, Peter, I was having a conversation this morning with one of Australia's top investors, fund managers, and we were laughing about the fact that it's the only thing that people buy, shares, that all of a sudden when there's 10% taken off the price, they take that as a negative. And we've said this many times at presentations, the sales on at the department stores, the fact that if we hear that a cafe around the corner is now selling coffee for $3.50, everyone goes there. But on the stock market, the sentiment goes the other way, that the thing's now cheaper, I'm going to shun it.
Yeah. And
it's just behavioural psychology, behavioural finance 101. And sometimes you can turn that to your advantage, and that's what a lot of these professional wholesale investors have to do, and that's how they get their performance.
Yeah. To me, it's like if you hear that a Paul Smith suit is 20% cheaper, that's a good time to buy a quality product. And it goes with shares as well. Let's go to some of the questions. This one's Richard from New South Wales. I'll give myself a rest, mate. I'll let you go first on this. Is it time to invest in bonds with increased risk in the equities markets?
Well, you should always have some bonds in your portfolio, and they do tend to go inversely to shares, not always perfectly, but look, the fact that bonds have been an asset class that obviously have gone to great heights, and this is the part of the inverse nature with the share market, and we've seen those record low yields. If you're talking government bonds, just grind ever lower, which of course means that more and more people are going into bonds. So when you say, is it time to invest in bonds? Well, no, not all bonds, because not all bonds are the same. I mean, government bonds, we saw only a couple of months ago, Peter, the unbelievable sight of negative yields in major bonds in Switzerland and Germany, because of the fact that the share markets looked so nasty and scary that a lot of investors were prepared to accept negative yields, to say to central banks, in effect, look, I'll pay you to look after my money. So government bonds are not necessarily, but corporate bonds can be very good value at times like this, and there are a lot of corporate bonds that do show some value, and really for investors who often find bonds uninvestable, those things are changing. And I note that we've got a question coming up on some of the groups that have allowed access to the corporate bond market through small investment sizes, which is a very good development for retail investors and self-managed super funds. In particular, self-managed super funds, because you've got some corporate bonds that are offering pretty good yields, and that just gives you a chance to, if you feel you're too heavily weighted towards high dividend paying shares, but you don't want to accept the pretty low yields on offer in the government bond sector, corporate bonds can be a bit of a halfway house. So yes, you can't say in a blanket sense it is time to invest in bonds, but as with any asset class, there's some areas of that particular asset class that offer good value.
Yeah, I'm not a great fan of bonds at this time, unless, as you say, James, you look at some of the corporate bonds, but you have to remember that if they're going to pay you a higher return, there's a higher risk. But there are some companies out there really, worth the risk, and some of the rewards are actually quite good. In terms of FIG, the question there, what are your views on FIG for investing? I think it's a pretty good organisation, and for people, and I think if people want some exposure to bonds, some of the products they offer are a good way to do it. James?
Well, that's so true, because until very, very recently, things like corporate bonds and government bonds were very, very difficult for retail investors to get into. The parcel sizes were very, very large, $500,000 in some cases, and that obviously precluded most people from getting into it. But FIG and a number of other houses have done some interesting things there, and FIG, for example, have broken up the parcel sizes into relatively small sizes, $25,000, $50,000 sizes, and that becomes ballpark achievable for investors and self-managed super funds. And I think it was only last week, Peter, that FIG crossed $1 billion worth of issuance of Australian corporate bonds, and that that has been the missing, or one of the missing links in our capital market for such a long time that we really haven't had a means for retail investors to get involved in corporate bonds, which is a different exposure to the company, and in many cases they're familiar with the name of the company and they like the company, but just the choice of getting involved in a different part of the capital structure, not the shares, but the debt instruments, the lending money to the company, that has proven pretty popular among investors. I think they've done 20-odd issues at FIG of Australian corporate bonds. And look, it's just been, the more the merrier when it comes to opportunities. The wider is the menu of investment opportunities, the better. And I think FIG's done a great job in opening up that part of the capital market and creating an asset class that retail investors can use.
Yeah, without doubt. So what stock sectors will outperform in 2016? It's clearly a guess, but I like anything that's of a small cap orientation. I think small caps will do well. So I'm going small cap industrials. I think financials will actually start to improve. I believe that 2016 will be a better year for economic growth than some people are predicting. And I think financials, which have had a bad year, will start making a comeback, particularly because a lot of the financials are dividend-paying stocks. I think a lot of people will chase dividends. If you're a thrill seeker, you might start nibbling into energy in the second half. And I know Michael Knox from Morgans has a pretty optimistic view on oil prices, late 2016 roll into 2017. But they're my standout ones at this point in time, James.
Well, I think the banks are going to perform reasonably well, but a lot of this is predicated on what we were saying before, Peter, that these stocks have, in most cases, become significantly cheaper than they were at the start of August, and with the yields. And look, if you're not worried that the banks are going to be cutting dividends, then you've been given some higher yields effectively on the market in recent times. And I often look at consensus analysts' target prices and expectations, Peter, and it's obviously not perfect to look at the consensus target price that the analysts have on stocks. They could all be wrong together. But you're looking at the major four banks. ANZ, for example, on FN Arena's collated consensus target price of the analysts that follow that stock, ANZ is implying at the moment upside of close to 20%, CBA close to 14%, NAB close to 13%, and Westpac close to 16% upside on where the analysts expect the stock to go to. Now, obviously, a lot of people hold these stocks, and so they're not new investors coming along and saying, oh, wow, these stocks are suddenly cheaper. But what it's done to the estimated yields, Peter, is also pretty intriguing, because the stock prices have come down, as I said before, and the yields go inverse to that. So ANZ's on 6.8% expected yield, CBA's on 5.7% expected yield, NAB on 6.5% expected yield, and Westpac on 6.3% expected FY16 yields. So I think those stocks, mostly positive views from analysts, I think those stocks will go pretty well.
Yep.
But I do take your point that there's some good value in our small caps. And how often, Peter, have we agonised over the fact that a lot of Australian investors don't go out past the top 20. We effectively have two stock markets in this country, the top 20 and the rest, and there's 2,200 listed stocks in this stock market. Not all of them are going to be viable, but the analysts that follow that sector, I remember one of them telling me not that long ago that there's close to 500 profitable industrial stocks that aren't in the All Ordinaries. And they're caught in a bind, these stocks. They don't get big because nobody follows them, and nobody follows them because they're not big. But there's some reasonably interesting, good situations there, and sustainable franked yields. Again, that's always, there's more risk down in that area of whether the dividend is going to be sustainable than if you're talking about ANZ, Westpac, NAB. But I think there's some good sectors out there, and industrial small caps, I agree with you.
Yeah, I must admit, sometimes I think people who are afraid to go into small caps, maybe you should look at a small cap fund by some of the specialists who specialise in picking out those companies that you're talking about that often get ignored. Now let's answer some questions, James. This one comes from Mike Rostron, no Mike, and he says, Peter and James, any views about primary healthcare? If you go a view off the hip, James, on primary healthcare?
Yeah, I think primary healthcare is looking okay. It's got some negotiations to do with hospitals, and it is doing that. But Ramsay has that. Ramsay's become one of our top stocks because it's got that overseas exposure. Now primary doesn't, but it's got some. I think it's got some potential tailwinds behind it. Just in our ageing population. The need for health services, and it's reasonably well focused there. Got some structural challenge in that how it acquires some of its doctors and the actual financials of the deal struck with doctors. So that's divorced from obviously the drive for medical services and the growth in use of doctors and healthcare services as our population ages. The market's been a bit worried with primary's negotiations with its doctors, but that's the main game for them. Still attracting doctors into the medical services, into the medical centres. But is that a short-term worry? Probably yes. The longer-term trend of the ageing population and the greater need for seeing doctors and healthcare services. I think, Peter, that outweighs in primary's case any worries about the pricing model for remunerating the doctors that they get into their centres. Yep. So it's got, I suppose what I'm trying to say to sum it up, the demographic push in healthcare is very, very strong. And I think primary is going to be a beneficiary of that, as will Ramsay, but of course Ramsay's got that added international diversification too.
Okay, and the FN Arena's look at analysts. It's $3.73 today, but the consensus target price is $4.91, so there's plenty of fat in the upside. Sentiment indicator is quite low, 0.1. For those people who don't know what the sentiment indicator is about, if you get a number like 1, it's a really high rating. If it's -1, it's a low rating. So it's kind of in the middle. And I think given what James said, it's like it's got potential, and obviously the target suggests that. And you're right, they've had difficulties with their doctors in the past. I think it's been a management issue. And given the fact that I know that, they should know that. If they get that right, that $4.91 may well be a reality.
And a 5.2% fully franked yield expected this financial year, Peter.
Yeah, which is not bad. You're right. Okay, and remember, this is at a bad time in the market. So if market sentiment turns around, you know, a lot of boats rise when the overall market rises. So interesting one. What's the next one we've got here? Peter Beaconsfield. You got a mic?
Yes, he does. Peter Beaconsfield, are you there?
Oh, what have we got here?
We can hear you loud and clear. Do you want to ask your question? Nope.
We lost him?
Yeah, we've lost
Well,
him.
Peter says, do you expect one or more of the banks to cut their dividends? They have a gross yield of over 8%. James?
I don't think we're looking at cut dividends. We mightn't be looking at dividend growth to the extent that it has grown in previous years. But as far as I understand it, Peter, you're still looking at, analysts are still expecting bank dividends to rise. And look, that was cut in 2008. The Big Four cut their dividends. So you can't say that it doesn't happen. They're under a bit more pressure. That 2008 was obviously an extreme level of pressure. They are under pressure from APRA to hold more capital against their lending, and which is pressure that's coming down from the global banking regulator, the BIS. So it's more difficult than it was given these new capital rules to boost your dividend, but the banks are still really generating the cash flows that enable them to do it. So I'm not sure we're looking at any of the major 4 banks and expecting a dividend cut.
No, and look, it really impacts on the reputation of the CEO as well, and they don't like to do it. And anyone who's ever wants to have a look at the history of dividends, say for example the CBA in particular, I think, James, ever since the float, I think they've only cut their dividend once. You might be better than me remembering that, but it was during 2008, and what they cut by in that half year, the next half year, the increase in dividend made up for what you lost in that particular half year. It's an extraordinary dividend story, and I don't think, unless this economy really slows down, and I'm wrong on my economic predictions, I do not expect banks to cut dividends. Yeah,
no,
you know what?
You're right. It was only in that absolute extreme of 2008 that they did it. They didn't want to do it then, and you're right. It's just something that they wouldn't do lightly because of the loss of status. I mean, imagine it. The market would be prepared to take one of those bank stocks out the back and shoot it if it did that.
Yeah, for sure. Okay, this is a question from Joe Ryan, J-O. Peter, what is your view on investing in property in the USA? Well, Joe, you should have asked that question 3 years ago. That was the great time to do it. I actually took my TV show to New York and interviewed the head of the biggest real estate agency in New York. I can't remember the name of the company, guys, so I hate to say, but it was right beside Barney's on Madison. So it was a very upmarket real estate agency, and apartments 3 years ago in New York were fantastic value. And some people, I think a lot of people bought in places like Texas. Interesting about Texas, you look like making a lot of money in Texas until the oil price fell. And this is the interesting thing about when you invest overseas. You've got to be very, very careful where you invest. And so, as I say, when our currency was $1.12 and US prices were down, that was a good time to do it. Given the fact our dollar's not all that good, I would not be a person desperate to buy overseas, unless you can pick a place where the currency is going to be worse. It probably would be an Asian country. James?
Well, that's right, and I know some smaller funds have done well doing it. It's, again though, for a lot of people, they looked at the prices of US residential property and thought, how good's this? And if you're only looking at price and the price falls, if that's what you're focusing on, then yes, there was some amazing value, but that's only compared to our domestic situation here. You had to know what was going on in that area. And location, 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 everybody understands that they are the 3 main rules in property. But I think at the height of that great opportunity you mentioned, Peter, there were people just prepared to do it on price without understanding what was going on in that neighbourhood. So I think if you went in and did it then just on price, you were quite possibly going to find yourself in a very bad situation. But there were some funds that did it, and there were some accountants that did some good work going over and spending some time there and finding out the areas, what was good about the areas, what was bad about the areas, things like the same things as here: schools, employment, public transport, etc. And they did pick up some good bargains. But yes, I'd probably think that given the way the currency is going, that's made it a bit tougher too. So anybody contemplating that now really should have another look.
Be careful of the currency implication. It was a no-brainer, as James said, if you picked the right area where people, and that's why I went to New York. People always want to live in New York, but 3 years ago, 4 years ago, America was really beaten up and there was good value. I would be very careful now. Next question, where we go? This is Anthony Hansen. Now, to what extent is algorithmic trading contributing to volatility? I think a lot. I can't prove it either way, but it's a new fad. It's with us forever, I think, in the new world, the internet world, and I think it's just the answer is yes, it does add to volatility. James, go a quick one on that.
Well, it does, because if you're just using artificial or almost automatic systems like that, there is no sentiment involved. That can be a good thing, that can be a bad thing. They're not really looking at stories and sustainability of cash flows and particular companies and what's changed economically. A lot of the time it becomes self-fulfilling and it self-feeds, and so you get these horrendous falls in pricing, and a lot of the time the algorithm joins that very quickly and dumps the stock, and it is very difficult to prove, Peter, because you can't really understand the motivations of every single buyer in the marketplace at any one time, but it's meant to join trends very quickly and not sort of stand above the trend and say, I know this stock well, I don't believe there's anything wrong with it. The adherence of it, say, it increases efficiency and all the rest, but look, I'm with you, Peter, I'm old school, and I think that it is designed to jump on board a trend and can't help but exacerbate it.
Yeah, I think right. I think the whole internet age where people can have loaded up, options, they can have, stop orders, all these sort of things just make this whole market we play far more reactive than ever before. Okay, here's a question from Chris. It says the tech charts for XAO, All Ords, and XJO are both down in trending pennants formed by a drop-in entry that normally continues in the same direction when breakout happens. Do you pay attention to these technicals? I gotta say, I plead ignorance on what you're talking about, but I do have a number of chartists who I go to for what they're seeing, and at the moment they're not telling me they're worried about what they're seeing. Admittedly, it was 2 weeks ago, and there's been some developments since then. And Chris Turnbull, you may well be picking up something that my chartist might tell me next week when I consult with them. But at this point in time, I'm not aware of, I'm not sensitive to it. James, have you picked up on this?
No, I'm not a chartist either, Peter, and I believe it can be very, very helpful to people who know how to use it well. I don't believe that everything is there in the chart. It's probably a cliche that a lot of people have heard before, but I only just heard it, Peter, that every sunken ship has a chart room. And
that's nasty. That's very nasty.
I certainly wouldn't poo-poo it as anything that shouldn't be used, but no, I don't use it, don't understand really the fundamentals of it, so can't really give an informed opinion on that.
Okay, but I would like to say this, Chris. Everyone knows how generally bullish I am, and I do believe there will be a bounce back of the market towards the end of the year. But I won't be surprised if there will be another big sell-off over October. The Americans say, it sounds very rude, but the Americans call October the month of bottoms, meaning that the stock market invariably will bottom in October. But we also know there have been some serious crashes in October as well. But before a bottom, a bottom means there has to be a drop. And so I won't be surprised to see another drop. I'm hoping that earnings season brings with it positivity and we get a kick out. Now, if that happens, then what the charts are currently saying will probably be proved to be wrong. But I do believe there's a good chance that there'll be one more or maybe two more sell-offs. I've got to say, I've got cash on the ready to buy on a significant sell-off, because I do think that the overall setting in the medium term is going to be good, so I'll be buying for the medium term. But I will definitely next week be talking to some of my chartists, and I'll see if they're seeing what you're seeing. But fundamentally, I wouldn't be surprised to see those charts actually bear some negative stories in the future. Okay, where we got now? Yeah, David Sando, good question too. What criteria do you use to select stocks to buy in the dips? Well, mine's very simple. I collect quality companies that pay dividends. I know it sounds damn boring, but that's my investment strategy. And so the days I like to buy are the days when everyone's really nervous. So Tuesday was a great day for buying, and I went around buying those companies that I hold in my portfolio. Some portfolios, some companies I bought at slightly higher prices. It was a perfect chance for me to dollar cost average, but I don't like adding too many new companies to my portfolio, but I do have a core, and usually the core don't get added to unless there are big sell-offs. But that's what I use, David. The quality companies that pay dividends when they've been really beaten up on bad days, they're the ones I go for. James, what's your technique?
Well, I mean, that's got to be the main criteria when you're concerned about the sustainability of your investment, is the dividend yield. Because one of my bugbears about the Australian investor population, Peter, is that they are solely capital gain oriented, and they think that's the only way that you get your return out of stocks, buying low and selling high. No, over the long term, half the return, or just slightly more than half, comes from the dividend. So yes, sustainability of dividend, it's a big factor when you see share prices come down and you get that increased yield. And I suppose it depends on your stage of life and your capacity for risk, but I also don't mind, Peter, looking at a story that's shot to bits and might be improving a bit. Sometimes management's actions can attract me to consider a stock worth buying. Something recent that was an example was Sims Metal Group, which should be the poster stock for this whole clean tech and recycling, that whole movement, which is obviously very, very important. They've been hit though because the iron ore price has come down, and that's made their scrap metal uncompetitive. But doing an amazing turnaround in terms of what the management can control. Really an impressive, put the whizzer through their entire business, Peter, and absolutely everything has been changed in terms of how it flows through to sustainability of cash flows and margins. So I'm a little bit more prepared to look for stories like that, where I feel that what the company's doing is worth rewarding with a bit of support. But you can't go wrong, as you say, with quality companies. And the further you go down away from quality, which is measured on earnings per share and dividend and all of that, you do have to start to go with a leap of faith. Now, that can work depending on your stage of life and how much time you can commit to owning that stock. But when you're getting down towards heading for retirement and needing income and needing capital growth that is reasonably well assured, then you've got to stick with those quality companies.
You're a young risk taker, James. That's your
a young risk taker.
Very young, very young. Let's go to this one. Good question from Lee Madigan. Is he available for a?
Try and unmute him. Yeah. Leon Matican, are you there? No.
Okay. So what are 3 disruptive companies one should invest in now for future growth? Ooh. Well, I think I've got to say this is not my chosen area, but at least one I would throw in the mix, particularly on days when the market's really getting very scared. I think Freelancer is not a bad disruptive company, and and probably zero if you get on those days when the market's been really horrible to those sorts of companies. I think both those companies have potential. They're not. Well, freelancer is definitely disruptive, and zero is taking on the incumbents, namely MYOB and Quicken and all that sort of stuff. But I think, you know, if you get them at good prices, yep. If you get them at silly prices, no. James?
Disruption, it's such an overworked theme, Peter. I'm a bit struggling to think of something off the top of my head that really does fit that bill, because it's become the buzzword that a lot of companies of the small cap, micro cap style, Peter, are trying to put into their presentations to try to give themselves some credibility on that matter. I'm at the right here, right now, struggling to come up with one, and even the ones that you mentioned, which certainly are disruptive, but you've always got to look, am I paying too much for the potential of disruption?
Yeah.
So it's something, it's become a buzzword, Peter, that we're old enough, of course, to remember several crashes, but you're back in the internet boom days where anyone putting .com or E into their company name got a lot of support. I think disruption is getting on for one of those buzzwords that people are trying to cloak themselves in.
Yeah, and the funny thing is, James, Leo's asked the question for very good reasons. If anything's worth doing, it's worth doing for money. And clearly, he wants to make money. But I think one of the best stories I've seen in recent times was when CBA in 2008 got down to about $28 at its lowest, James. So when you think about what it's done since then, the strategy for all younger people should be just wait for the next crash, let the prices fall, let everyone get panicked, and when people are at their most panicked, go in and buy companies like CBA and just watch the money roll in. James?
Well, that's right. A lot of these disruptors will become very successful stocks or companies that are become boring dividend payers. It's like what we were talking about before, Peter, with China wanting to become more like a Western economy, more driven by its own domestic consumption. Eventually, these sexy companies will want to be a bit less sexy and just more concentrating on stable dividend increases year after year. At the moment, of course, there's a lot of promise, and yes, if you get disruption right, you'll make a lot of money very quickly. But I'm a bit sceptical of companies that self-identify as disruptors.
Yes, right. When we see the next Google and Amazon coming, we'll be the first to tell you, Leon. Okay, what next? One thing from, that's a good question from John Spalding. Origin Energy issue. Question. No brainer, James?
This is a very troubled situation because right up until this issue was announced, Peter, the noises coming out of the company were that they didn't need to do it. So I'm still wrapping my head around it, and the deep discount, etc., etc. Look, it's a scenario that I'd like to do a bit more, or have a bit more of a look at, but I think the market was extremely surprised at this, to put it mildly.
Yeah, I've got to say, yeah, I know it's a bit of a joke, but I'm really going cold on these heating energy companies. But what my promise will be to John is that over the course of this week on my show, I'm going to look into a company like Origin. It's I can feel the tone in your voice that you're pretty disappointed at what's happened, and me too, quite frankly. Okay, we've got a couple of other questions here. What ETFs do you suggest for investing in Europe, the UK, and India? Now, I did a bit of work on this one when I saw this question coming through. What I came up with was for Europe, there's an iShares one called IEU. And the reason why I like that one is that it's got about 350 companies in it, but it also has a bit of UK in there as well, and I like that addition to the mix. When it comes to the UK, Richard, EWUS has been the best performer, and it's an MSCI UK small cap ETF. A lot of the ETFs, for obvious reasons, it's been a bad year in the stock market, are in negative territory. This one's up 6.76%. And given the fact that both James and I and just about everyone else think that the part of the cycle ahead of us is going to be good for small caps, that's a very interesting one. So obviously I'm not recommending you going to these, but these are the ones you should research. These are the ones that look the best on performance. And there's another good one in the UK, very interesting ticker code, FKU. I don't know what they were thinking about when they came up with that one. I guess they couldn't do FUK, could they? They've been in a lot of trouble with that. It's a UK Alpha Dex fund, so it's looking for high performing funds, up 4.43%. Okay, it's noticeable that the iShares EWU one is down minus 0.7%, and that's a reflection that they'd be more taking in the overall market. And finally, for India, I'm not an expert on India, but I did a bit of research for you. The best one over there is a small capper, SMIN. It's only down 1.49%, and that's pretty good considering a lot of the ETFs in the Indian market are down fairly big numbers. James, you got any thoughts on that?
Well, the interesting thing about ETFs, and I'm a big fan of the product generally, Peter, is that they started off as being pretty broad. You invested in an overseas market index, and then they became, you could get the single country exposure and regional exposure, and now they're starting to get things like strategies coming in where you buy a portfolio that's built according to a particular strategy. I just think the menu is very, very wide, and it really looking at that menu and deciding what is your own need or requirement for a particular exposure. The product manufacturers have come to the party by widening the menu. There's I think there's 120 plus ETFs listed on the ASX at the moment, and they do now have that really good choice between a broad market index like a world index, or even the IEU, the iShares S&P Europe 350, or the S&P Small Cap 600 in the US, which is IJR. So they give you really good targeted exposure, and you can go down, if you like, into individual markets. But I would also have a look at some of the newer ones, particularly there's some global dividend yield ETFs, which matched up with the Australian one, Australian dividend yield ETFs. You could put together a portfolio, Peter, that's quite individually targeted using ETFs, and I would just say to people, have a look at the menu, have a look at some of the newer strategy and style-based ETFs, and just use the chance to look for the exposures that you want and that suit you. Yep. Because the menu is very, very wide these days.
Yeah, and I must admit, I avoid the synthetic ones. I want ETFs to actually buy the stocks. It kind of worries me a little bit when we start adding ETFs to derivatives, but that's just my personal feeling. Maybe I'm far too cautious. Here's one last question before we go, James, and it's a beauty. Can CBA fall below $65? Would such a drop result in a dividend fall too?
Well, no, because companies control what they can control, and they control to a large extent their earnings, and they certainly control their dividends, but they don't control their share price. Yep. So CBA could fall to $65. I don't think it's going to happen. I think it's going to head in the other direction. Well, that's right. It could. You must tell investors that it could. There's no reason why not. But if it did, I don't think its dividend would be cut because of that, because the dividend flows from the earnings, which don't have any relationship to the share price. So it would make CBA more attractive as a dividend-paying stock. Its yield would rise above 6.5% if that happened, and that would be, or probably higher, and that would make the stock more attractive. Yeah. So if it did, I think it would start to bounce up, but No, I don't think it would result in the company cutting its dividend to match the fall in the share price. In fact, I'm saying that it would make the dividend yield look more attractive than it currently is today.
Yeah. And George from SA, if this happens, if we do see CBA at 65, I will be out there telling you it's going lower, because a drop down to 65 would be on the back of a recession, probably worldwide recession is going to hit Australia, and it may well go down to 45, but I'll be out there buying when it gets around 40, 45 this time around. So that's my view, and James is absolutely right. It will increase the dividend yield. The dividend could be cut for a half year or even a year, but it'll still be a real good dividend. That's the point. Where we are now, the dividend's great, and even if they did cut dividends, it'd still be a very good yield. So let's be realistic about this. Okay, James, thanks for joining us. It's been a great pleasure hanging out with you for an hour. I only usually get 10 minutes on my TV show, and so it's been great talking to you for an hour.
Did enjoy it, Peter. I hope I didn't cut myself off with my positioning of my webcam. I just realised that might have been a problem.
No, it doesn't matter. As long as the brain and the voice was there, that's all we needed. So, mate, thanks for joining us, and everybody else who's out there in webinar land.